Okay, earlier we completed up to three units, right?
Yes, sir.
Yeah, okay. Now we are going to discuss the capitalization. Anybody are from Telugu medium? Okay, I will continue with English and both bilingual language. Okay, uh, just open the your book 62, page number 62. Okay, capitalization means nothing but according to Gautaman and Dogel, what is meaning by capitalization? Capitalization means nothing but the sum of the par value of outstanding stocks and bonds. It means if, for example, we take any public issued companies, for example, Tata or any Reliance Industries. For example, we take Reliance Industries. According to Reliance Industries, capitalization means it is nothing but total asset value equal to, or otherwise capitalization is equal to total assets minus current liability. Just see here, this is the formula for the capital employed. Capital employed means nothing but total assets minus current liabilities. This thing we call as exact value of particular company's capitalization value. Okay, so in this chapter we discussing about the how much capital required for any organization to continue smoothly. So depending upon the organization it will be changed depending upon the financial for financial manager, depending upon the financial manager's efficiency, it will be useful. It will be effectively useful, utilized by the financial manager. Okay, somebody used exact what exactly company required that amount they will utilize it. Somebody they will utilize less amount. Somebody utilize the more capital amount. So based on the effective utilization of the financial manager, effective utilization of that particular resources, that company will be depending growth will be depending upon the effective utilization of the capitalization. Just to see the capitalization is nothing but, just 1 minute, sorry. If any organization uh, runs smoothly, they will need some money. They will need some assets. They will need some effective organization skills. So, uh, according to the Gautam and Dogel, what he defined means capitalization is that is nothing but the sum of par value outstanding stocks and bonds. So what exactly if for example we take any installment, I'm showing annual report of Reliance Industries. So based on that, we will discuss. Okay. This is the annual report of 22, 23 annual reports of Reliance Industries. So here, just you see the actual revenue, how much revenue they earn in 22, 23 means 2,60,394 crores they earn. This is the actual revenue. So here, just we see. So this is the market capitalization of Reliance Industries. How much it is? 15 lakhs 77,093 crores. This is the Reliance Industries market capitalization. So we are discussing this thing now. Okay, just see this value, and we are discussing about this value market capitalization things. So according to the Reliance Industries, the market capitalization value is 15 crores 77,093 crores. So according to the Reliance Industries, that value, how we gain means based on the capital employed. Capital employed is nothing but total assets minus current liabilities. Otherwise, uh, total liabilities minus current liabilities. Then we will get the current capital employed. Okay. So how we calculate this capital employed? We have two methods for calculation of this capital employed. One is historical cost theory. Second one is earning theory. So according to the historical costing theory, capitalization is considered to be equivalent of cost actually incurred on setting up the corporation. So how much cost we incurred for setting up the any organization, that we called as capitalization. The amount of capitalization is based upon the original out of the pocket and investment in plants, machinery, and equipments. So how much cost we incurred for establishment of any organization, that thing we called as capitalization according to this historical cost method. Okay, coming to the earnings method, according to this earnings theory, the principal earnings are forecasting and capitalized at a required rate of return. So every year we earn some amount. So for example, see this Reliance Industries. This is the revenue. Okay, so according to this revenue, we calculate the this earning theory. Based on the revenue, we calculate the earnings theory. So, according to this theory, the principal earnings are forecasting and capitalized at a required rate of return. Required rate of return is nothing but what we are thinking this year, how much we are getting the return. So, based on that thing, we will calculate the capitalization. So, for example, it is estimated from the pro forma profit and loss account of the firm. The profit of this particular 22-23 year, the profit is 3 lakhs. If normal rate of return, every year normal rate of return is 10% per year. So this is the 10% per year. This year, how much profit they will get? They was get 3 lakhs. So the required investment will be how much based on these two things, how much required rate of ఇన్వెస్ట్మెంట్ విల్ బి అని చెప్పేసి అడుగుతున్నాడు వాడు. సో బేస్డ్ ఆన్ థింగ్, సో వీ క్యాలిక్యులేట్ ది క్యాపిటలేషన్ వాల్యూ, దిస్ ప్రాఫిట్ ఇంటూ 100/10, దెన్ వీ విల్ గెట్ ది యాక్చువల్ క్యాపిటలైజేషన్ వాల్యూ. దిస్ వీ విల్ కాల్ యాజ్ ఎర్నింగ్ థియరీ మెథడ్. సో these are two things to calculate the capitalization. Then after, types of the capitalization. So types of the capitalization means here we have three types of capitalization. One is over capitalization, second one is under capitalization, third one is optimum capitalization. So there are basically three types of capitalization. These three types of capitalization. One is over capitalization, second one is under capitalization, third one is optimum capitalization. However, in general, we use two types only. One is over capitalization and under capitalization. So over capitalization is nothing but it refers to state where the company is unable to earn reasonable returns. So returns on the funds. A corporation is over capitalization when its earnings are not large enough to yield than the rate of return on the amount of stock and bonds that have been issued. So here over capitalization is nothing but if this year we want to earn how much? 10% of return. So if we actually how much capitalization we want means 30 lakhs. So every year we are getting only 10% of return on particular investment. How much of our investment means 30 lakhs. So this is our capital value. So in this particular capital value, how much return we are getting? 10% of return we are getting. So how much rate of return? This is 3 lakhs. So this 3 lakhs is we call as profit. If we use actually we want only 30 lakhs of the capital value, but we are using 40 lakhs 40 lakhs. Then how much rate of return we are getting? Only 3 lakhs. 3 lakhs means then automatically equity shareholders they are getting less returns because of the overcapitalization. Okay, that's the reason this overcapitalization is affect the equity shareholders value, and also it will affect the company's net worth also. So this overcapitalization is not suggestible for any organization. Then causes for the overcapitalization. Uh, Verify the factors can be cited because of overcapitalization. The earning capacity of the particular organization will be poor. Okay. Then after, and also it will be decrease the dividend paying capacity also. Okay, these are the main disadvantages regarding the overcapitalization. Then undercapitalization. Undercapitalization is evident of in the company has consistently maintaining the abnormal high earning capacity, and if the market value of the company shares continue to stay well in excess their book value. For example, we have our company is getting more returns and more profit. So then we are investing less amount. For example, every year we are getting 3 lakhs of return. So then we are investing only 20 lakhs only. We are investing only 20 lakhs. Then our capacity will be reduced because of reducing less amount of capitalization, less amount of we are investing. Then we are get the 10% of return only. Then that means we are get the less returns. Okay, under capitalization also it will affect the organization. So basic main effects means uh, risk is that the high profitability meet invite the intensive competition from the ambiguous promoters, high tax ambiguations, and invitation to government control and intervention of other possible risk. Share price of the undercapitalization companies will show tendency to risk and fluctuate the volatility, and also speculators will be tempted to drive under out advantages from such as share price and variations. Continuous high profitability of undercapitalization company will induce relations may get the impaired uncertain company's performance and results. It means because of undercapitalization, our company value will be automatically will increase. So investors they will think that every year this organization getting more profit. So automatically that company worth also increased. But in actual performance, that internally their worth is very less because of undercapitalization. These are two things in we are considering undercapitalization and overcapitalization. Coming to the fifth chapter, that is capital markets. In financial market, we divided into two things. One is money market and capital markets. Money markets deals only short-term investments. Capital markets deals the long-term investments. Okay, long-term means more than 1 year. Short-term means less than 1 year. So here capital markets first. The term is market. Market means nothing but any place or process that brings together buyers and sellers with a view to agreeing price. So two things here. One is sellers and buyers. They are grouping one place, or they are sit in one place and agreeing by price. They are accepting the agreement, or they are accepting the purchase or sell the good. That place we call as market. The basis of how an economy operates through production and subsequent exchanges means here, in return, every person in market, every person they sell the goods and they purchase the goods. In between, they are exchange their money. Okay, this we call as market. Then after, so actually, anybody have less sufficient money, then what they are thinking, that which place they are investing. So everybody not investing in investments, everybody not investing in stock market or any land and buildings or any other. They will keep only some amount for future purposes, and they will not invest in these things. Okay, they will invest it in the real estate, or they will invest in land, they will invest it in buildings. So that money continuously flow from one person to another person, then automatically economy also will boost up. So they will not think to invest in these places, these things. One is bed and parts. So this thing they will not think to invest. So coming to this fifth unit, capital markets is nothing but financial markets is physically virtual place where entries and individuals can trade financial securities at low cost and at market determined price. Here, financial markets is nothing but any place sellers and buyers getting together. They will sell and they will buy the products, or they will buy the shares with low cost and market determined prices. So financial markets is nothing but is a physical and virtual place. Virtual means online, and where entities and individuals. Entities means organizations, companies, banks, any partnership firms, also traded firms. They will these entities, they will come and purchase the stocks or shares. So here, this thing we call it as financial markets. Financial markets are broadly divided into two types. One is money market and capital market. Capital market is nothing but it consists. Now, capital market is consisted two things. One is primary market and second one is secondary market. So primary market is initially they will issue the shares to mobilize the funds to establishment of any organization. Primary market is according to the stock market, or according to the this thing. Capital markets, they are divided into two things. One is primary market and secondary market. Primary market is consist of issuing of new shares. Secondary market is issued and listed shares. They are traded. So we are actually traded in stock market. What we traded already listed shares. Then only in secondary market they will trade. Okay, in primary market, what they will do, they are mobilize the funds based on issuing of new shares, debentures or preferential shares, or taking the loans from the banks or other institutions. Okay, through they are collecting the money for establishment of new organization. So overview of capital markets. In capital markets, organization mechanism of effective and efficient transfer of financial resources from the investing parties to the entrepreneurs. So any entrepreneur, they want to establish any new organization, what they are think the huge amount of capital they will require. So what they will think to taking the money from outsiders, where they have sufficient money, then they will collect the money from the different sources. For example, they will collect the money from banks, lenders, and also they are issuing the equity shares. Likewise, they are collecting the money from different sources to establish the organization. Okay, financial markets can be categorized. One is unorganized and organized segments. So here earlier we discussed financial markets. Here we are so entire. I mean, so in India or in financial perspective, this financial system entire financial system is like this only. Okay, financial system consists of in financial system they consist of financial institutions, financial markets, financial assets, financial services. So here we are discussing this financial markets. In financial markets, then we bifurcated into organized and unorganized thing. Organized here also organized financial markets we divided into capital markets and money markets. Capital markets then we subdivided into primary market and secondary market. So this is the financial market. This thing only we are discussing in our business finance book. Okay, so financial markets organized and unorganized. Okay, here. In financial market can be divided into organized and unorganized. Organized segments consist of capital markets and money markets. Unorganized segments consist of money lenders and indigenous bankers. Capital markets deals only primary and secondary market. They are issue and they are listing and issued shares they traded in the secondary market. Then why we need the primary market? What is the importance of primary market, and what is the need of primary market? Okay, primary market is nothing but it is a new issue market. New issue market is when any company needs when any company needs the funds, they will collect the money from the issuing of equity shares and debentures or preferential shares or debts. So they are raised the funds using long-term source of funds, issuing of corporate securities. Ownership securities is nothing but equity capital. Creditorship security is nothing but debt capital. For we are collecting the money from these two ways. So equity capital means nothing but actual owners of the particular organization or particular company. Debt holders is creditorship holders. Actually, every year they will get the fixed rate of interest for taking the loan from the through debt capital. For equity shareholders, they will get the dividend every year. Based on our profit, every year they will get the equity capital. They will get the dividend. Futures of primary market. Futures of primary market is it is a new securities originate and a new issue market. The purpose of setting of new business or expanding mobilization existing business. So then why they are issuing this primary market, primary new issue securities means for the setting of new business or expanding or modernization of the organization or existing business. So investor buy the securities direct from the company. For this place only, they will directly purchase the shares through directly from company. Then after issuing the primary market, then they will trade in the stock market. So then only they will purchase the through secondary market, converting the private company into public company. This we will call as going public. This is the methods of floating new issue. So then, in what way they are collecting the money means this is the different methods they will collect the money from investors. They will collect the money from the public. One is public issue. Then second one is rights issue. Third one is bonus issue. Fourth one is private placements. So first, initially they are collecting the money from the public issue through what way? One is initial public offer. Second one is further public offer. So every organization initially they will issue the prospectus. They will issue the prospectus. They will collect the money from the general public through equity shareholders through our debt capital. Just see the recent IPOs. 1 minute. These are the new IPOs. One is So these are the methods of sorting new issues. So first one is public issue. That is the initial public offer. Second one is further public offer. So initial public offer we call as initially they are issuing the prospectors to collect the money from the public. Then second one is further public offer. Uh, Further public offer means when an already listed company makes either fresh issue of shares or make any offer for the sale of the public, it is called as further public offer. Means initially they are issuing the shares to the general public. Then after they are initially they are collecting the money from some amount from the public. Then after they are issuing the remaining shares to the further public. Okay, this is we call as initial public offer and further public offer. Rights issue. Rights issue is nothing but when an issue of shares is made to the existing shareholders, it is called as rights issue. It means it is not rights issue is nothing but this issue is made to the existing shareholders only. So then we call as existing shareholders. Then we call as rights issue. Bonus issue means when shares are issued to existing shareholders as on a record date without any consideration from them. So rights issue they will collect some money from existing shareholders. For bonus issue they will not collect the money from the investors or existing equity shareholders. Okay, this is the basic difference between the rights issue and bonus issue. Rights issue is this issue is issued to only existing equity shareholders, but they will take some consideration, or they will take some money from the existing shareholders. But for bonus issue, they will not take the money from the existing shareholders. They will they will issue the free to existing shareholders. Private placements means it is preferential issue. Second one is qualified institutional placements. So preferential issue means when an issue is made to the select group of persons as per SEBI guidelines, it is called as preferential allotment. Second one is qualified institutional placement. Qualified institutional placement is nothing but when an issue is made to the to qualified institutions biased as per the provisions of the SEBI guidelines. As per SEBI guidelines, they will they will take the uh, the SEBI already declared some qualified institutions. Okay, we will call as qualified institution. Book building method of public issue. So this is a very important concept, and every time they are asking this regarding this concept. Uh, accord- Initial they are issuing the shares with the fixed rate of share par value. But after the 1995, according to IAH Melgam committee recommendations, this book building method of public issue they are using nowadays they are using book building method of public issue. But earlier they used fixed price method of issuing of shares. Now they are using the according to the committee recommendations of Malagam recommendations. They are using book building method of public issue. So fixed price method over pricing or underpricing loss to the investors of the company. Earlier we used that fixed pricing method. So in this fixed pricing method, investor they are investing the they are taking they are investing the money in the particular company. Sometimes full, for example, any organization issuing the IPO, so that IPO value is 100 crores, for example 100 crores. That 100 crores they will collect within 5 days. Some less known company, they will collect the money less than the 100 crores. That means 80 crores, the 70 crores they were collected. That time we will call as underpricing loss, or less IPO, less amount we are getting. So that drawback is happening in the earlier fixed price method. Coming to the price of the share is not fixed by the company, but decided through the bidding process called as. So what we call as what is the definition in this particular book binding is the price of the share is not fixed by the company, but decided through the bidding process. Okay, how they bid means just to see. So this is the main difference between the fixed price issue and book building issue. So in earlier the meaning of the fixed price issue under this specific method, under this fixed price specific method, the shares issue price is given in the prospectus and investors must buy at that price only. For example, each share value is 100 rupees. So then that fixed amount, that 100 rupees only, they will uh, they will be purchased. Otherwise, they will not allow the shares to particular investors. Coming to this book building process, under this method, issue price gets the finalized through the bidding method. The bidding investors will have to be bid between price band provided by them. For example, same issue price is they are issuing 100 rupees between the 100 to 120 rupees. So in between, the investors they will purchase. It means they will purchase in between. They will bid the price. Somebody bid the 110 rupees. Somebody bid the 120 rupees. Somebody bid the 100 rupees. So in between, they will bid the price for purchasing of the shares. And the pricing, the price at which securities get allotted intimated to the investors in advance. So earlier, this share value is 100 rupees. So this amount earlier they were uh, intimated to the particular investing general public. Coming to this book building issue, the price at which securities are allotted it is not disclosed to investors in advance, and they only get know indicate the price range. So they indicate the price range. How much price range? For example, 10 to 120 rupees. In between, they will purchase the lot. So demand for the security is known, and after the issue is closed, the up to issue IPO is closed, then only they will get the how much demand we are getting. For book building process, demand for the security is known every day as the book gets the built. Okay, every day we will know of the update. We will know update about the book build, how much shares today they are purchased general public. So likewise, we will know in the particular book building process. But coming to this fixed price method, uh, we don't know exactly how much demand we have. So then payment is made during the time of subscription, and refund is provided after the allotment. According to this fixed price issue, payment is made during the process of subscription. In the process of subscription only, we will pay the money. And, coming to this book building issue, payment is made after the allocation. When allocation is done, then only we will pay the money. The payment type application supported by the blocked amount and UPI. So in fixed price issue, uh, uh, we pay the 10,000 or 20,000 rupees to the particular purchase of that particular shares. So that amount is blocked in particular this system. But here, book building issue, the application supported by the blocked amount and you pay same. Likewise, they blocked the money for allotment up to the allotment of shares. So here, here reservation is up to 50% of shares reserved for the applications that are below the 2 lakhs. And here coming to this book building process, 50% of shares qualified institutional buyers, 15% of shares for the retail investors, 35% shares for non-retail investors. Prospect Prospectus. The company prospectus must issue the prospectus that should contain all the details about the initial offering, including the price at which shares are providing and the number of shares offered. So, in company prospectus in fixed price method, they detailed mention about the each share value, how much they are collecting, and through equity shareholders, how much they are collecting, and how much they are issuing, and through debenture holders, how much they are collecting and how much they are issuing. So likewise, in prospectors, they in detail they will mention in particular prospectors. Coming to this book building process, the company must issue red herring prospectors and the total size of the issue and the price bond. So the company must issue a red herring prospects. The company that total size, how much they are issuing and how much uh, price band means nothing but in between how much how much percentage they are collecting. That thing they are mentioning the red herring prospectus. It can be used for the almost any issue. such as ESOS, rights issue, and public issue, and more. So this method is earlier they are using for the rights issue and public issue and more. For book building process, it is generally used to public issue and such as FPO and IPOs. This method is after 1995. We are using now book building process method. So this is the main process in the book building process. Book building process is nothing but initially initially SEBI and initially ROC, Register of Companies, they are announce the prospectus. In this particular prospectus, what they are announce how much price value and how much shares they are issuing. Each share value they are mention the particular prospectors. But coming to this book building process, so earlier fixed pricing method, they are getting less or more amount. So because of that drawback, based on the recommendation of the particular committee, we are using this book building process. So this in this particular book building process, we have some process. First, initially we are appoint the one book runner and a runner and lead manager. First, for appointment of for issuing a prospectus, first what particular enterprise, what they are doing is initially they are appoint the book runner and lead manager. Then after this entire IPO, they are taking care of entire things about the IPO. So what book runner and lead manager, what they are doing is they submit the draft document to the first. Initially this BRLM, they submit the initial prospector documents to the SEBI. So earlier they are submitted to the ROC, but uh, because of this book building process, first we appoint the book runner and lead manager. What they are draft the document, then he submitted to SEBI, then decide the price band. So how much after submitting of the draft document to the SEBI, then they will decide to the how much percentage, how much price they are announcing, how much price band, how much they are initially offering. The price band is they are decide. Then after advertise the issue of shares, advertise the issue of shares to mentioning the opening and closing date of the bid. Usually, any IPO, they offer the shares only 5 days. So, in this particular 5 days, they are issue the IPO. Then after order received into a electronic book. So this entire orders they are taking 1 minute. So after advertising in any recognized or any uh, public newspaper in public advertisement thing, then we issue the shares. Then after we are taking the orders, we are receiving the orders from the electronic book. Bids can be revised by the bidders. Then after close the bid, book runners evaluate the bids on the basis of the demand. Okay, seventh one is what after taking the bids from first initially we appoint the BRLM, then BRLM submit the draft document to the SEBI, then they are decide the price band, how much price band they are thinking, then they are advertising the issuing price, then they are taking the orders from the public, then they will bid or then they will modify the particular price band. For example, we are issuing 100 to 120 rupees, then they are fixed the share, that particular share value, then they close the bid, then BRLM will decide cutoff price of the allotment, then final prospectus giving to the ROC. ROC means nothing but register of companies. So how much shares we are allotting, and each share price and entire thing we mentioned, and we submitted the final prospectus to the ROC. So actually, general procedure is ROI. ROII means retail individual investors. So for retail individual investors, we are that, but every company they will issue up to 35 percentage of share, 35 percentage. NII means non-institutional investors, they are allowed the shares up to 15 percentage. Then qualified institutional buyers, they will allot the 50 percentage of shares in total IPO. So then allot the shares successful bidders, then refund the amount to the rest of the bidders. So these are all the important steps in public issue. So these are all the important steps to in the public issue. One is preparation of the draft prospectus, then fulfillment of the entry norms, and appointment of underwriters, appointment of bankers and brokers for issue, initiating the allotment process, printing of prospectus and application of the forms, and publication of issue in newspapers, allotment of shares, underwriters liability, listing of shares in recognized stock exchange. So these are all the important steps to the issue of issue of shares to the public. For first, they prepare the draft prospectus. Draft prospectus, what they are contain? They are contain the how much share price bond, and how much they are collecting from the equity shareholders, how much they are collecting from the debenture holders, and how much loans they are taking, and what is the main business of particular organization, entire thing, and what is the registration office and register office, and how much directors, independent directors, how many are independent directors, and how many are from uh, active active directors. So likewise, entire things mentioned in the particular prospectus. Then they are fully fulfillment of the entity norms. Then after appointment of underwriters. Underwriters is nothing but uh, initial they are issuing the IPOs, issuing the general public. They will accept the issue or they will not accept the issues. Then that will be effect to the particular organization. Then they approach the underwriters. Underwriters is nothing but if up to the 100%, 100 mark, they will if shares issues, and then so then they are appoint the bankers and brokers for the issue, initiation of the allotment process. Then after completing of the issue, then allot the shares to the particular subscribers. Then after printing of the prospectus, allotment of forms they print and they giving to the particular equity shareholders. Then the filling documents with SEBI and ROC, publication of issue in newspaper, allotment of shares, underwriters liability. These are all the main terms in the terms they are using in the offer document. One is a draft offer document. Second one is red herring prospectus. Third one is prospectus. Fourth one is letter of offer. Fifth one is arbitraged prospectus. Sixth one is placement document. So each one has different meanings. Draft after document is nothing but initially, initially particular organization they will prepare one draft document for submission of the SEBI for specifying how much charges they are charges they are incurred for issuing of particular prospectus, and before they are giving to ROC, draft offer document is placed for SEBI website for enabling and public give their comments. So before giving to the prospectus to the any document to the ROC, first they will give to the they were given to the SEBI. SEBI they put in that document in the SEBI website. Any queries and any doubts in this particular issue process, mm, SEBI will clarify that we call as draft after document. Second one is red hearing prospectus. Red hearing prospectus is nothing but it is an offer document used in the case of book building method of public issue. It contains all relevant details except the price of the particular share, and also it is fill the ROC but, before the issue opens. Okay, this we call as red herring prospectus. Prospectus, the third one is prospectus. Prospectus, it is a offer document in case of public issue which has all relevant details including the price and number of shares being offered. This document is registered with ROC before issue open, and case of fixed price, and after the closure of the issue, the case of the book building issue. So after the allotment of shares, after the complete of entire thing, then this document is prepared and this document is given to the ROC. Then that document we called as prospectus. Letter of offer. Letter of offer is nothing but is an offer document issued to the existing shareholders in case of a rights issue, and it is filled with the stock exchange before the issue open. Then this thing we called as letter of offer. Abridged prospectus. Abridged prospectus is nothing but it is an abridged version of the offer document in public issue, and is issued along with the shares applications from the public issue. It contains all silent features of the prospectus. Sixth one is placement document. Placement document is nothing but it is an offer document prepared for the purpose of qualified institutional placements, and it contains the relevant material disclosures. Up to this level, I concluded thing. Uh, Remaining things we discuss later. Can I stop the class?